It can't be a black swan by the very understanding that we all know about it. Black swans are risks that we don't understand. So for us, at best, it's like, when does it happen? Sorry, at worst is when does it happen? At best is maybe it doesn't happen. So we all understand the risk, but it's geopolitics. We have no idea how this plays out. I understand that the Russian situation put it to the forefront of people's minds, and it's definitely a possibility. But I don't think China wants to cut itself off from the world, and I don't think the US wants to cut itself off from China yet. So I don't think it's in anybody's interest. It's kind of this stalemate situation where it kind of rises up. It's like North Korea, South Korea. It's not a solution where anybody actually wants to pull the trigger, but they want a position until maybe they can find an opportunity one way or the other to resolve it. How? What that means? I don't know. Could the Chinese invade Taiwan? For sure. Does it happen in the next 6 months or 15 years? I have no idea. You know, we had a global macro investor roundtable, my research service in the Cayman Islands in May, and we had a bunch of very smart, well-known investors all together. And we debated this for a while. What is the shoe that drops? And the answer came out, the economy. It feels like this is more likely to be an economic event, but everybody's looking at it as a credit event. And there's nothing going on really in credit markets to give us that fear. Yes, they're not great, of course, because the economy's slowing down and there's liquidity tightening. I don't see that one moment. Now, the one thing that's different about this one to the last one since maybe 1990 is there is a supply issue. So we've got high prices. Now, we had a demand issue in 2007 in commodity markets because China had come in and massively bid up the price of all commodities. And that helped slow the world down because the commodity prices were too high and inflation was high. There are elements of 1990 and there are some elements of the 80s. Now, everyone uses the 80s as the big example, right? That the Volcker years, right? The reality was the S&P fell 27%. We've pretty much done that then. And 1990, it fell 20%. 1990 was a pretty common garden recession. We had the savings and loan crisis. We don't seem to have a credit event on the horizon. Now, I know other people have thought maybe it's to do with commodity hedging. Well, most of the commodity prices have gone down, so that fear has been alleviated. I don't see it. I think it was just the unwinding of the excess liquidity from the pandemic, and we returned back to where we were back in about 2018. As I said, they priced in a very significant move, much like 1980-81 did, much like 1990 did. People look back immediately and go, well, look what happened in 2008. Your 2008 was a very unique event. That was a massive credit event. 2000, well, the economy didn't go down a lot, but there was massive speculation in equities. We haven't seen the same. We've had excess liquidity, some excess speculation, but not of the scale of then. Most people who comment on that didn't live through it. I lived through it. I was running a hedge fund at the time. I was all over it. It's very, very, very different environment. We saw elements of it last year, at the very peak of the markets. We saw elements of that, but it's still extremely different. Confusing me right now, to be honest. I'm expecting yields to come lower. We've seen the economic data come lower. We've seen the oil price come lower. We've seen inflation numbers come lower. We've seen the equity market come lower, and it's been stubborn. And I think it's based on narrative. Also, I have a suspicion it's something to do with the student loans and some hedges around that. I don't know. That's speculation. I've been trying to figure it out. What is driving this flow? Because it's really inconsistent with everything else. If you wipe off a debt, there's the other side of the debt, and there's usually a hedge. Usually these things are a spread. So if you're lending people money against it, you'll buy a bond as a hedge. So you have the difference in interest rates between the two, as opposed to worrying about the bond market going up and down. If you just wipe off one side, you've got an open leg, which would have been the long bond leg, which would have been sold. I don't know if that's the case, but that's what it feels like. Maybe it's happening by the Treasury General Account. I don't really understand, but it feels like there's an opposing flow that's going on because it's just not consistent with anything else, which is why I'm really focused on the bond market, because it seems the best risk reward in all of macro land right now. The bond market's not confirming it. And, I want to see the markets confirm it. It's great to have an economic view, but if the markets don't do it, you can't invest in it. So, I'm waiting for the turn. I'm expecting weak economic data for the market to give up the ghost. Positioning is pretty much second all-time record short bonds as well. The equity market pretty much is record shorts. So we've got all this setup where everybody, I think, is set up the wrong way. And those trades get unwound if the economy doesn't follow through. Mark Ritchie, the second, was talking about this yesterday on the daily briefing. It's like when the market isn't doing what you expect, like 70% of people think the equity market should be going to new lows, and it doesn't. There's usually informational value in that. Now, could there be informational value in the bond market? Not possibly, but then it would be confirmed by other assets, and it's not been confirmed by anything. Well, what broke first was the long duration stuff. So, particularly with inflation and taking liquidity away, well, the first things that go are the things that are priced for future growth, because you basically lower future growth. As you raise the discount rate, your future expected cash flows are worth less. Now, the issue is, if you have no cash flows, it's worth a lot less. So we find that these long duration things, crypto and growth equities, they got smashed the most. They were the ones that benefited the most. Now, that's not to say, again, we'll go through this in due course, crypto is not correlated in the longer term to any of these things. It's correlated in the liquidity cycle to the liquidity. But if you look at the chart of NASDAQ and crypto over the last 10 years, I mean, they look nothing like each other, has priced in about 32 in the ISM, which would be the lowest ISM print since 1974, which when it got down to 30. So it's been very much priced in, the inflation shock, the growth shock. So that's really what's going on there. And then you have to wait around to say, okay, what other shocks are there? Then you start watching credit spreads. Is somebody borrowed too much money and they can't pay it back? We haven't really seen a lot of that. Yes, we've seen credit spreads. We've seen Europe having a bit of a struggle, Italy. But the ECB came in as ever and said, we will not allow this to happen. And I kind of believe them. Because when you've got an unlimited balance sheet, you can stop anything happening by buying all the bonds, much like the Japanese do. So where is the big risk? I don't know. I think it's households. It's, everyone's spent all their savings. Everyone's run up credit card debt, and people are going to start losing jobs. And they've lost real earnings because their earnings have gone up, but inflation's gone up more. So the purchasing power of everybody's wages have taken a haircut. We've had terrible negative wages, and that's been a bad shock for people. Basically, a general economist will tell you we'll never predict a recession. Why? Because they use linear modeling. They put inputs in, make a few assumptions, linear model. You show a small child a chart of GDP and they go, well, it goes up and down, obviously. Not one economist does this. It's insanity. So back in the late 90s, I started realizing that the business cycle was the predominant driver of asset prices. And just by transposing it to year-on-year S&P versus the ISM, it unveils the whole world. So the ISM survey, as I said earlier, for people who've just joined us, it is the Institute of Supply Management survey, and we're asking the buyers at all of these giant corporations, industrial companies, what they think of economic conditions, employment, orders, new orders, prices, everything. And it becomes this composite index, and guess what? It goes up and down, just like GDP, but it's like a monthly version of GDP. Right. Tends to lead a bit too, because GDP takes a while for accounting. Right. So now we've got this monthly variation of this. Those things, what you're looking for is turning points at the peak. Then you know that the rate of change of growth is slowing down.